Hello, everyone, and welcome to our July podcast. My name is Carly Purcell. I am joined here with
Ryan Schuffer,
Derek Van Solkema,
Patrick Cummins.
Good to have you.
Yeah.
So, Ryan, July, kind of a mixed bag.
Yeah, very, very well said. Mixed bag, and I hope that everyone got out there and enjoyed, 4th of July, 250 years of independence. That's wonderful. It's been a good summer, at least in my household, and I hope the same is true for you. But look, that's not what we're here to talk about. We're here to obviously talk about the things impacting your money and your portfolio. So, Carly, you said it, mixed bag. So, when you look at the S&P 500, it's basically flat. So flat, down 0.06%, 0.06%. So we'll call that flat. The bond market, though, had a little bit tougher time, down over 1%. The aggregate bond index, which is just a basket of bonds we use to gauge how did fixed income do for the month, was down 1.3%. So for those of you that are uber aggressive and all stock investors, forget what I said about the bond market, although it does have some direct impact on equities. But this is more for those diversified portfolios set up for withdrawals, retirees looking for that extra gear of diversification. So anyway, mixed bag is what I would say, for the month of July.
Yep, and then more specifically for client portfolios.
Client portfolios, we did our movement that we needed to do in June. Late in June, and that actually held up pretty well for July, and we'll talk about that here shortly. But we just did some things broadening out our stock exposure. The growth trade has been really wonderful for, the last decade, truly. But sometimes when something's done really well, it tends to represent a bigger portion of your portfolio because it's outperformed. So sometimes it makes sense to go through and kind of reset the deck, make sure that those opportunities in other areas of the market are being explored and expressed within your portfolio. So portfolio movement happened last month.
So kind of, hitting on the S&P performance for the month, pretty flat. But below the surface, there's a lot of activity. What can you tell us about that?
Yeah, so S&P 500, top 500 companies in the U.S. So top 500, I didn't say that they were all specifically one type of tech stock, one type of financial stock. Now, why did I just pick those two sectors? Because they were very different for the month of July. So Derek, you bring up a good point. Flat market, but if you look below the surface, take it one more dimension deeper on your analysis, there's some keys there. Because when you look at financials up 6+% in the month of July and tech down 3+% in July, you combine those two and then some other sectors, you can come out with a flat market. There's a lot going on in that tech space. And quite frankly, if you recognize the clues there, what you're seeing is a broadening out, but also an opportunity to kind of clear the decks, I think. And let's face it, when something outperforms for extended periods of time, you end up with concentration. You end up with so many people just focused on that one sector. And Derek, I think that's kind of where you're going to go with this next piece is what does that look like?
Well, it's, market slang, it's taking out the trash, right? Kind of flushing out some of those excesses in the market. So, with that trade and maybe that tech sell-off, are you seeing that as, maybe an end of the sustainability of the AI trade, or is this kind of just a little bit of a market reset there in that tech cycle?
Yeah. So there's a lot of dynamics and dimensions to that, that general statement, like is what's going on with the AI spend and what have you. I'd say that if you look at companies that are perhaps being punished for capital expenditure into that AI, artificial intelligence space, they're actually making money on those CapEx expenditures, but it does make investors a little bit nervous when a company comes out and says, hey, all the revenue that we made this year, we're going to go spend it on something, and we hope it brings money in the door. Well, I think that our big tech companies have proven that they're pretty good at allocating funds. But on a broader term, I think it's very healthy taking out the trash, right? Let's say that, to get those bad actors out of the market that are not investors, They're more in it for a trade. They're more in it. They're not long-term investors. They're in there to get in and out perhaps, or do something that's not sustainable over the long term. Something that's not typically sustainable over the long term, using a bunch of leverage, borrowing money to invest it somewhere, right? Enhancing your exposure to something. That's just all of a sudden greed's getting the best of whoever's doing that. If they're thinking that that's something that they're going to do for the long haul, and the market will make it where it doesn't last forever. And it's times like July when those who were so focused on such a narrow sector in tech, for instance, they blow up. But taking out the trash, those who were uber leveraged in memory stocks, they had a big, volatility event in the month of July. If you were leveraged in that space, investing irresponsibly, it was a lot of pain for you. So when the market can do that, Warren Buffett said, when the tide goes out, you see who's swimming naked. It's that kind of same expression there. It actually sets up for a healthier backdrop going forward. And I'll say it like this, rather than taking out the trash, think about it like building a structure. Every floor you go up, you want somebody to go inspect the perimeter and make sure that the studs you're using are of the highest quality component materials. And if you find something that is lesser quality, you want to take it out and put something that is nice and sound in there, so that as your building is getting built, that the structure is nice and sound and firm. July did that for the markets.
Yeah, I mean, to everything you're talking about, we're looking at a rotation of asset classes, right? We're seeing this happen over the past few months. Some people leaving the AI trade a little bit and finding more value companies and other things. Speak a little bit on that, and I know you have been.
Right. Rotation. Rotation is indicative of a good thing. It's we want not just a market rallying on a narrow focus, just a few types of stocks rallying. We want broadening. And when you get that broadening, what you're having is all of a sudden stocks that were maybe unloved, places in the market that really haven't caught a lot of attention, all of a sudden get the attention. Financials haven't been great for the last 12 months, I'd say. And, again, you could fact check me on that, but it seems like that's the range there. And all of a sudden they have a wonderful month. And then tech, which has just been permanently good, has a rough month. All of a sudden, that's actually healthy to see. And so think about some of the tilts we made at the end of June. It was acknowledging that it seems like it's time for a bit of broadening.
That's right. And these healthy rallies, they lead to one thing, and for a lot of people, that's taxes. All right, so that's why for this next topic, I want to cover a little bit more of the financial planning side, and that is looking at taxes and how they relate to you guys. Right? So really just base level here, knowing how your account pays taxes or how you will be taxed is important. Each account you have, whether that's an IRA, a Roth IRA, or brokerage account, is going to have different tax characteristics that you need to be aware of. And Ryan, what are some of those things you might want to be thinking about when it comes to that?
Yeah. Very good. So, Patrick, to reiterate, it's like you get this healthy rally. What do you do with the theoretic wealth that would be created in that environment? And I'm not talking about like right now. It could be into the future. I mean, we don't want to say we've got a crystal ball here. But in the same breath, anytime you have success in a portfolio, you sure hope that it's in the right silo, if you will. Because see, every account, generally speaking, is going to be taxed differently. An IRA, a Roth IRA, a non-IRA account. And you want to make sure that those accounts are all holding the proper type of asset for that account. So let's go back to this farming analogy. A silo that allows air to flow through, perhaps that's best to hold your corn. I don't know this. I'm not a farmer, right? But theoretically, it makes sense. And then, the one that keeps it moisture out, that's for the soybeans. Well, your portfolios, if you have multiple different accounts, should be looked at in that same lens, in that same view. You would theoretically want your growth engine in your Roth IRA. You would want to find defense in your IRA, and then look to create capital gains with a non-IRA. And then all of those together in aggregate can land at the prudent asset allocation for you. Because generally speaking, there are three types of taxes that we are confronted with our wealth. Regular income tax, traditional IRA, distributions, things like that. Capital gains tax, which is for non-IRA funds. And then you have what's called a sheepment tax, which is just a fancy way of saying transfer tax. This is the estate tax.
Mm-hmm.
A lot of times nobody gets up to that level. It's very high these days, but it is out there. And then you've got Roth money, which is no tax. So Patrick, you bring up a great point. We want to bring more financial planning topics into this podcast, and taxes are so important to you. So anyway, please reach out if you want us to kind of do a deep dive for you.
And we'd love to work with all of you guys.
Yeah, absolutely.
But looking after that, what do we see ahead? Right? What is the next month, the next few months going to look like for the market?
Well, I wish I could tell you for certain. But no, you know what? Look, the bottom line is you get a month like July out of the way, and I think it gives you confidence.
Yeah.
Because, again, you get that broadening. You know, the bad actors are flushed out, taking out the trash. Thanks a lot, D. And, you know, when you look at the backdrop, you know, the economic data, kind of this Goldilocks environment, not too hot, not too cold. You know, there's a lot of liquidity out in the market. That M2 number, again, total liquidity is pushing higher. You know, you've got midterms coming up, which sure, there's a catalyst for volatility, but you also got to think about that volatility. Volatility cuts both ways. You know, you might have politicians looking to make things look really good leading into that. So I'm actually quite constructive on where we're at. And I think you can be too.
That's great.
What do you say, Carly?
I say on to the next month.
There you go. Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thanks for tuning in. We'll see you next month.